Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So we did just get a recent CPI print, and it did come in hotter than expected. Now, I think that the market is certainly making a big deal about it, and I wanted to use this video to sort of explore what's going on underneath the hood, see if is the market overreacting, what's going on. All right. So first thing we're going to look at is headline inflation, and the reason why we've seen such a notable reaction by the market. If you were to go take a look at, by the way, dominance is at 54.31%. In case you're curious. But if we were to go take a look at the dollar, you can see the dollar has had a pretty big move here, back up to 105. I've said before, I probably going to see the dollar higher in 6 months than it is today. I've said that a couple months ago. Not only did the dollar go higher, but we also have seen things like TLT go lower as the long end of the yield curve continues to go back up, right? So if you look at the 10-year yield, it's back up to around 4.5%. 30-year yield is back up to 4.562%. So the longer the yield curve is going back up on this news, the dollar's going up, and of course TLT is going down as an artifact of the long end going up. Now, was it that big of a print to merit all of that? Well, if you look at what's going on here, has inflation reaccelerated or has it stayed the same? I would argue that at this point, it has mostly stayed the same. Now, I could see it reaccelerate, but I still think we are a little ways off from that potentially happening. I'll talk about that more later in the video. If we look at this, headline inflation hit 3% in June of 2023. It is now, 3 quarters later, and we're still between 3 to 4%. Now, we already went up to 3.7% in August, and then we came back down, and now we're going back up again, and we're at 3.5%. But all in all, it still is just between the 3 to 4% range, right? It hasn't really taken out these highs over here, but it also hasn't been able to go below these lows. And we said before that that last percentage is going to be the hardest percentage to get. To go from 3% to 2% is a lot harder than 9% to 3%, right? To go that last percentage is really the extra mile. That's what really is going to make things challenging. And that's why I think a lot of the market participants continue to question the Fed's resolve. Will they stay the course until the job is done, like they have said, or will they pivot sooner, leading to some other type of outcome? Now, with it being at 3%, it sort of raises the question. We'll sort of look at a monthly change here. This is the monthly change. So you can see that it really hasn't been very negative for a while here. I mean, a couple of negative months, but mostly positive, roughly around 3 to 4%. But it raises the question, where is it coming from? So if we break this down by category, first we'll take a look at headline inflation. So this is headline inflation. This is the same thing we just looked at, right? You can see, all right, it's at 3.5%. Now we're going to go through each category. Here's food and beverages. Food and beverages went from 2.25 and it stayed flat at 2.25. So one of the reasons why inflation didn't really get any better this month is, well, this category stayed flat. Housing actually went up. Okay, so that is a bit of an issue. It could be an anomaly, but this is the first month where housing saw an increase rather than a decrease since January of 2023. Right? I mean, it's been a long time since we saw this as a positive. And is it just something like this where you just get 1 to 2 months and then it goes back down? I think there's a case to be made that that could happen. But this is one of the reasons housing makes up a large contribution. We'll talk about that in a few minutes. And so with housing going up, that contributed a lot to the hotter inflation print. If you look at apparel, you can see that it's back up a little bit to about 0.4%. Transportation also back up to 4%. So again, this is one of those ones that went deflationary back in the summer of 2023, and now it's been slowly trending back up. Medical care also went up, pretty big jump actually, back up to 2.2%, all the way down from negative 1.4% back in September. Recreation went down. This has been one of the stickier ones. As you can see, it has taken a while for it to come down, but it is now less than 2%. So another category that has finally reached that 2% level. Education and communication dropped down a little bit. Other goods and services also dropped down slightly. So remember, not all categories are treated the same. And if you look at it as a contribution, because it's weighted, if we look at it as a contribution and we zoom in over here to, this is headline inflation right here. Let me reset this. So this is headline inflation. Now look at food and beverages, right? It makes up only 0.3 of the 3.5, right? So a relatively small contribution. Look at housing though, right? Housing makes up a much larger contribution. And so when you get that increase coming from the housing market, that's what leads to this. So I think that, it could still stay sticky for a while longer, but my base case is that it still continues to not go too much above the current range for a while. Now, what could cause it to go above the current range? Well, if the Fed pivots too soon, right? If the Fed pivots too soon. The counter argument could be made, and I've said this many, many times, is that the pricing out of rate cuts could eventually cause them to get priced back in. What do I mean by that? Well, if you go look at the watch tool here, this is what it looked like yesterday. Rate cut in June is what it looked like yesterday, right? Now reload the page and see what it looks like. I already reloaded it over here, but now rate cut not till September. So rate cuts are getting priced further and further out. So what did I say a long time ago? That ultimately the pricing out of rate cuts could eventually lead them to being priced back in. What does that mean? It kind of feels like it's a bit hand wavy, right? What it means is that there are so many companies and businesses and people that are expecting lower rates, right? They're expecting lower rates. And they keep not getting them, right? So maybe they're holding on for as long as they can. They're saying, all right, well, if we just wait till rate cuts, then demand will pick back up. Rate cuts keep getting pushed further out and further out. What happens, right? Eventually those companies throw in the towel and they say, well, we can't do it any longer. We can't operate like this any longer, and they shut down. So if this continues, right, the pricing out of rate cuts could eventually cause them to get priced in. And what could be the issue for the Fed is that inflation is still very, very sticky, but the unemployment rate is starting to trend up. Now, this last month, it actually went back down a little bit, but you can generally see that whenever it goes above its 24-month moving average, so if we pull up a 24-month moving average here, you can see, generally speaking, it doesn't take long before it starts to move higher, much higher. So I think the issue for the Fed and where the markets may eventually have an issue is what happens if you have a 4% unemployment rate, but you also have 3 to 4% inflation. Then what does the Fed do, right? Because again, I mean, they have a dual mandate. It's inflation, keep inflation down to 2%, get it back down to their 2% objective, but also for maximum employment. It's been so easy for them forever for monetary policy because you got a secularly tight labor market and you got inflation running wild. So the only thing you can do is really just keep raising rates and keeping rates elevated, quantitative tightening. But now we are getting really close to the point where there's a risk, right? If they continue to stay too tight for too long, then it could lead to a policy mistake. If you think about it, they made a policy mistake back in 2021 when they didn't raise rates and they let inflation run rampant. What happens if the opposite is going to happen now, where they look at lagging data coming from, say, like the housing market to tell them not to cut, when in reality there are some categories that are already back at 2% and have been at 2% for a long time? So I think that is kind of what we have to be aware of. There is a chance that the Fed makes a policy mistake, and the reason that policy mistake could happen is all of these rate cuts keep getting pushed further and further out. if this happens, it's probably gonna lead to more bankruptcies. If you're not familiar with what I'm talking about, I'll just go look over here at bankruptcies. So look out at United States bankruptcies, and you'll see, right? I mean, they've been going up very, very quickly here. Okay? And those are going to continue to go up more than likely, as long as rates continue to stay high and rate cuts keep not arriving. So at some point, we're going to reach a threshold where it affects the labor market, and then the Fed is going to have to cut so that we try to avoid some type of nasty economic downturn. We're still not there yet, right? But you can see how it could theoretically happen as these rate cuts just keep getting pushed further and further off. Now, how do you navigate something like that, right? I mean, with crypto, I've said before, right? For crypto, my focus has just been Bitcoin, because I think Bitcoin dominance is going up. It gives you exposure to the upside and minimizes your downside risk, right? So if there is a nasty crash, Bitcoin will likely recover a lot quicker than a lot of the other coins. That's how you continue to be an investor, right? Because again, it's hard to just do nothing for years and years and years, and that's why I've said relentlessly, look at Bitcoin dominance. It's likely going to go up no matter what, right? And if it's going to go up no matter what, right? Then Bitcoin gives you exposure to the upside while also minimizing your downside risk, right? We've said this 1,000 times probably over the last 2 years. And Bitcoin has gone up a lot. Dominance has gone up a lot. And because rate cuts keep getting pushed further and further out, dominance is likely going to keep going up. Remember, last cycle, dominance did not top until after rate cuts arrived, right? Bitcoin USD topped before the first rate cut, right? But dominance did not top until after rate cuts arrived. Rate cuts still haven't arrived yet, and it looks like they're getting pushed further out. Because they get pushed further out, Bitcoin dominance keeps going up. But at some point, and who knows when it is, but at some point, we reach a level where dominance breaks above 55%, goes to 56%, and makes its way probably to 60%, and then the consumer finally weakens, right? Then alt Bitcoin, I work it in every video. What is wrong with me? Then alt Bitcoin pairs break down, just like they did here, which by the way, when they broke down here, the Fed pivoted 1 month later. I don't care what this says, right? These probabilities change every day. Every day, basically, these probabilities change. And if you looked at this 2 years ago, they would have said we would have never gone to 5.5%, which, by the way, in 2022, I said many, many times, the terminal rate is likely going to be 5.5%. No one believed it back then. They were talking about much lower rates. Here we are at 5.5%. So when we look at monetary policy, I don't really care what these probabilities are, because they're going to change, right? In the same way that they just did change. Yesterday, the market was projecting rate cuts in June. Now they're not projecting rate cuts until September. But what happens if in the next month or two, alt Bitcoin pairs break down? What happens if in the next month or two, the unemployment rate goes to 4% and bankruptcies continue to go up? Then all of a sudden, all these rate cuts that keep getting priced out could get priced back in. Again, I'm not saying we're there yet. For me to believe that we're there, I would have to see alt Bitcoin pairs break down. Until that happens, right? Until that actually happens, then the next phase of the cycle has not yet begun. But that, I think, is the tell. When they break down, haven't broken yet, I think they're going to eventually. And a lot of them are already breaking down. Individual alts are already breaking down for anyone who cares to look. And look at them today. A lot of alt Bitcoin pairs are down and Bitcoin dominance is up. So you have inflation that's still remaining sticky. The market is reacting to it, right? The market is reacting to it. It's pushing the rate cuts further out. It's going to make businesses more and more desperate for lower interest rates, and it's going to cause probably some companies to go bankrupt because they can't survive this forever. Some of these more risky companies, they just can't survive it forever. But the larger ones can, right? And that's why you see the same way that Bitcoin dominance goes up. Guess what else has probably gone up? In something like Nvidia dominance, if we track that, I bet it's gone up a lot too. And look today, I mean, Nvidia's up on the day while a lot of other stocks are down. It's all about that flight to relative safety, right? Relative safety, right? Look at the Russell, it's down 2%. While the Russell's down 2%, Nvidia's up 1%. You know, someone said the other day, how can you base this crypto stuff? I mean, we've only seen this happen one time for crypto. So how can we base this on what happened over here? Guys, this is monetary policy going back thousands of years, right? During higher rates, you know, this type of environment, high risk stuff bleeds to low risk stuff, right? Altcoins bleed to Bitcoin. Alt companies bleed to blue chips. So, you know, inflation continues to remain sticky. My guess is that that means that liquidity will continue to leave alts and go to, you guessed it, Bitcoin, the king. Bitcoin dominance at 54%. We talked a lot about, and we got the halving coming up soon. And we'll see if it can, you know, if it's going to repeat what it did over here, where it sweeps those prior highs. But a lot of things to consider here, guys. And, you know, my thought process right now with inflation is that it's not reaccelerating just yet, but I could envision a scenario where it could, okay? But if it does, I still think it would probably not be until maybe next year, okay? If it does, which I'm not even convinced that it will. I know a lot of people are comparing it to the 70s. And again, maybe that's a valid comparison. And we could follow the 70s if, say, later this year, let's say we get an unemployment rate print at 4%, and then the Fed turns the money printer back on. And then we just show we haven't learned our lesson from the 70s, and then we get another wave of inflation. That is a potential outcome that I don't think anyone wants to live through, because then, you know, anytime you go to the grocery store, you're going to be spending $400 instead of $300. And I don't want to do that. I have 4 kids. That's why it's $300. But I don't want to go through that. You know, I'd prefer for inflation not to have a second wave. But if the Fed cuts prematurely, then we could get a second wave. If they cut prematurely, we could get a second wave, just like we got in the 70s. And if you look at the 70s, it bottomed out here at 3% and then started to go back up. The issue is if it starts to reaccelerate, the market tops, right? If it starts to reaccelerate, the market tops. In the 40s, when it went deflationary, we had a deflationary crash. Guess what happened? The market went down. That's why you hear people talk about hard landings and soft landings all the time. It's because if the Fed stays too tight for too long, it leads to a deflationary crash and the market goes down. If they don't stay tight enough and inflation reaccelerates because the Fed's cutting rates and turning the money printer back on, then you could get a crash because inflation reaccelerates. How do you get the soft landing? So how do you get the soft landing? It's not impossible. There are examples where it's happened. Look at 1967, although we did a hard landing 2 years later. Even in the mid-90s, we had soft landing. We had a soft landing. It's not impossible, but it's difficult to manufacture because you have to keep rates high enough for long enough to make sure that you don't see inflation reaccelerate. But if you keep them too high for too long, you could get a deflationary crash like we got in the 1940s and like we got over here in the late 2000s. So, you know, engineering a soft landing is not a simple feat, right? And you know, I think a lot of people are sort of declaring that it's been done. Look, it's possible that you could get one. It's just how can you know yet? I mean, if inflation is still above the Fed's target and the unemployment rate is still going up, how can we sit here and declare anything has been a soft landing, right? Because you see inflation going up. I mean, it's mostly just flat. And you see the unemployment rate slowly going up. So it's too early to declare victory just yet. Powell has said that many times. And this print here is certainly kicking the can down the road on when rate cuts are going to arrive. Now, the only question is this really kick the can down the road, or will it lead to rate cuts being priced back in because the market can just not bear it anymore. How do we know? I think alt Bitcoin pairs will tell you. Altcoins are a lens into the consumer, into the average consumer. As long as they hold here, the Fed has not gone too far. As long as they hold. When they break, if they break, if and when, that probably means the Fed has gone too far. That's my guess. That's my guess. I could be wrong. I've been wrong about a lot of things. I'll be wrong about a lot more things. But that is my general guess. And my stronger conviction is that regardless of where those things go, you guessed it, the Bitcoin dominance is going higher. And not that long ago, it put in its highest weekly close this cycle. And the only thing that has changed since that weekly close is that rate cuts have been pushed even further out. And if rate cuts have been pushed further out, high risk will continue to likely lead to low risk, meaning the Bitcoin dominance is going to go even higher. And eventually, we reach the point where all the pricing out of rate cuts causes the market to throw in the towel, and then all the rate cuts get priced back in. How do we know when that happens? Likely when alt Bitcoin pairs break down. Thank you guys for tuning in. Make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time. Bye.